Bank of Japan. They're keeping the rate steady, they're leading the yen to tumble even further. So how much longer can Japan take the hit from this weakening yen? Japanese yen right now, they're under tremendous downward pressure. For one thing, the Federal Reserve gradually going back to its hawkish tone. That's not helpful in terms of the yen strengtheners. In the same time, the US rising treasury yields and the interest rate differential between the US and Japanese currency and Japanese economy is certainly not helping the Japanese yen. That's why BOJ governor warning that the weak yen could cause rising risks in the country, especially overshooting prices as a whole. And in the meantime, these factors could actually put Japanese authority in terms of BOJ and also a Ministry of Finance into a dilemma between supporting Japanese growth, as well as stabilizing the yen. And don't forget that weaker Japanese yen is also hurting Japanese companies as well. Imagine a place where everything money-related is frozen in time. For almost 3 decades, your salary doesn't budge, the price of your unagi bowl doesn't change, and the interest rate on your home mortgage is closer to zero. That was the reality here in Japan. They were used to the price of everything staying pretty much the same. But it wasn't always like this. Since the end of World War II, Japan has been ground zero for some of the biggest experiments in economics. Now, Japan's central bank has decided it's time to end its latest experiment and exit negative interest rates. For the first time since 2007, the Bank of Japan, or the BOJ, raised rates.
YCC gone, the end of negative rates as well.
So how did Japan decide to manage its economy so differently from the rest of the world? And how is this massive shift going to disrupt everyday lives across the country? Japanese growth hasn't always been this stagnant. At one point, the economy was growing so fast that it looked like it was about to overtake the US as the world's biggest. After the post-war devastation, Japan achieved something called economic miracle from the 1960s to early 1970s. That growth was led by a huge domestic demand because the middle-class households were expanding. And in the late 1980s, Japan's economy actually accounted for about 10% of the world's total economy. At the time, many were flush with cash and reckless spending was the norm. By the end of the 1980s, the stock market was on the up and up, hitting record highs. What was crazier was the real estate price. For example, the land price of Tokyo's Imperial Palace was said to be equivalent to the price of the state of California. Then the bust came. In the first of its shock moves, the BOJ sharply raised interest rates in 1989, trying to curb speculation and rein in inflation. The government also introduced measures to cool the property sector. Nikkei's stock price index fell to half of its peak value, and real estate prices also plunged. That led to a long-term downturn. Authorities had tried to pump the brakes, but instead they sent the economy to a screeching halt. People in Japan didn't experience wage growth and inflation for about 3 decades. That means one generation full of people. Living in the world and no inflation makes people attached to a certain product with a certain price. A small amount of inflation can help drive economic growth by keeping money moving around. Most economies target relatively mild inflation of about 2%. But as you can see from the yellow, Japan's inflation stayed below that for a long time. As things got worse, the Bank of Japan followed the typical playbook for central banks, lowering interest rates. You can see the Fed, for example, slashed rates to cope with the fallout from the 2008 financial crisis. But the BOJ, for more than 20 years, kept at it with its almost flat line, but it didn't help lift the country out of deflation. In 2013, the BOJ decided to do something drastic again. It introduced the quantitative and qualitative easing policy, an unconventional move where they basically print a lot of cash and pump it into the market by aggressively buying Japanese government bonds. It was successful at first, but Japan faced deflation again a couple years later, so the BOJ went back to its box of tricks. In 2016, it adopted negative rates, a move that divided economists. The main goal was to deter saving and also punish banks that hoarded cash, but that didn't really work either. In response, the BOJ invented something called yield curve control. Yield curve control is an attempt that the BOJ controls not only short-term, but also the long-term rates, so that businesses and households don't have to worry about too much fluctuation in interest rates. It could keep interest rates low by threatening to buy bonds, without always having to actually buy them. That still didn't solve everything. Companies couldn't find enough profitable ways to invest their money in Japan. Many ended up looking abroad for better returns. so much so that Japan became the biggest foreign holder of US Treasury debt, overtaking China. Suddenly, in 2022, all of that changed. Japan finally hit its 2% inflation target. The problem was what prompted it. First, it was higher energy costs due to the Ukraine war. And second, a weaker yen. Bank of Japan was continuing to ease monetary policy to stimulate the economy and even inflation. However, other major central banks hiked rates in order to fight inflation. Eventually, it was external forces that pushed Japan toward ending its experiments. In other words, it was not the sort of inflation that Japan wanted, because it wasn't coming from consumers spending more. Wages stayed low, even as inflation hit 4.3% in January 2023, which was the fastest in decades. But it still caused the yen to weaken, boosting profits at companies like Sony and Toyota, which sell products abroad. That finally brought about some signs of change. The business leaders, who used to be reluctant to raise compensation, now started to become open to raising wages. The main labor unions secured the biggest wage increases in 30 years. So finally, on March 19, 2024, the BOJ took a big step.
The Bank of Japan has ended negative interest rates 17 years since the last hike.
They're scrapping the yield curve control, and they're also going to essentially pare back their purchase of ETFs.
Raising the interest rate from negative 0.1% to a range of 0 to 0.1% doesn't seem like much, but it does put Japan back in line with other economies. We asked at the top that if Japan's negative rates experiment ends, what now? Well, here are some of the changes we can expect to see. First, mortgages will get more expensive for the first time in decades. And interest payments on the government's more than $8 trillion of debt, which is about twice the size of the country's economy, will increase. The same thing will happen to companies. It could also propel the yen higher. That means your trips to Japan could get more expensive, and Japanese exports would take a hit too. On the flip side, it can also make investing in Japan more lucrative. Plus, cheaper fuel and food imports are good news for Japanese consumers.